next Fed chair might matter more than the one we currently have. So if you thought, I kind of know what the Fed does, but not really, this morning is going to be for you. If you trade futures and options and stocks and you think the Fed is background noise today, that's adorable. I'm going to ruin that illusion. By the time we're done, you're going to have a checklist and a plan for knowing exactly what to do today between 155 and 230 when the algorithms lose their minds. All right. Good morning, everybody. I hope you are doing well. Good morning to our friends in the member room. Good morning, Lyndon. Good morning, Doji. Good morning, Randy. Yeah, text on. I know that Eric in Northport's out there somewhere, so hash pipe as well. And to new people joining us in the Market Masters room, good morning, Captain Kirk. Lou in Texas. Eric is there. Submarine or Monica, I hope you guys are doing well. All right. So today, a little bit different. I think it's important to do this now and then, and so much so that Don is going to join me today at 2 o'clock when the Fed makes its announcement. In a conversation the other day with everybody here at TheoTrade, Don said, I actually think this Fed meeting is going to matter, which that's unusual. He usually just says, it's usually noise, and then moves on to something else. But no, today actually does matter, and today we'll have some chatter about what the tie color is and things along those lines. But we'll talk about momentum. We're going to do a runner, but it's going to come not at the typical time, so scratch that out. Morning scratch. Let's just call that a rain delay, if you will. If you're joining us today, you're doing it for a very important reason. We're going to talk about what's actually worth engaging, what's worth trading, what sets up. If there is X, then you do Y on a day like today. Whether the market's safe or if there's a trap day, look, there could be an announcement today that throws everything into disarray. They might just cut rates and then set guidance and say, we're not cutting all of 2026. The dot plot is going to matter. The internal politics is going to matter. And keep in mind, there's still not a guarantee they're going to even cut rates. You're at 87% on CME Fed Watch. Market's obviously pricing that in. But there are certain questions that remain. So we have to be agile and we have to prepare for a day like today. Now, before we get to this, I do want to point out that momentum is positive in the broader market. S&P 500 is green. If we look at futures right now, you're not going to expect to see a whole lot of changes today. It's going to be some positioning ahead of time. When we get to around that 12 o'clock hour, that's where we're going to look for positioning, and then we're going to pay very close attention to the fact that, silver hit an all-time high. Again, 62.14, continuing to run. Another sign of the times. We're watching energy. We're watching the S&P 500. We're watching the Nikkei. Everything is in play on a day like today. But we're kind of coming into an intraday of even territory. And that is kind of setting us up for what are the institutions going to do? What will happen when the hedges are lifted or changed? We'll find out. But the Russell's been chopping around the last couple of days. Our intraday reading has weakened from that extreme breakout coming off that November 21st rally. And now it begins. So a reset. Let's talk about what this stuff is and why it matters. And we're going to go through a lot of detail here, okay? What the Fed does, why today matters, how to trade this 2 p.m. decision. So why are we doing this? Well, that's pretty simplistic, right? It's pretty simplistic. But the reality is this. When you really take a step back and you assess this, what is the Fed? What does it do? Why does it do what it does? On paper, the Fed has that dual mandate. Maximum employment and stable prices. All right? As defined as 2% target inflation in the long run. Now, this was derived back in the 1990s. They came up with this concept because they wanted to protect the labor market, but also in the 1990s, 3 major things happened that were very deflationary, meaning prices would drop, meaning that the value of your home nominally would decline and the value of your salary would also go down, most likely. Even if your food prices went lower and your healthcare prices went lower, there were deep concerns in the 1990s that if the value of your home and the value of your salary went down, Americans would revolt. So they came up with the concept of inflation targeting, 2% a year, but they didn't tell anybody until 2010 that they were doing that. And that was important. But there were three major things that happened all at the same time. The fall of the Berlin Wall, that added billions of people to the global workforce. China was ascending. That was also deflationary, very low costs in the global manufacturing world. And third was the dot-com revolution. The shift to the internet was extremely deflationary. Now, all of that said, the three big things that matter to us of what the central bank does is it sets its policy rate. The Fed does not control every interest rate in the world, but it does impact it indirectly. It sets a target rate for funds. Very important. It sets a target rate. Now, that target rate is critical because that overnight rate that you'll be talking about today, that Fed funds rate, what the hell is that thing? It is the rate that banks charge each other overnight for reserves. So right now we're in a world where the market expects them to cut that interest rate by 25 basis points for the third meeting in a row. Now, why is that important? Because, again, you're at 90% probability because, well, we run a pretty big debt here in the United States, and we are looking at a rate that is tied to consumer costs and to what banks are doing with their reserves. Now, at the same time that this is happening, we're actually seeing the 30-year bond going up. And the question is, how will this rate cut impact other areas of financing in the U.S. economy? The Fed also runs a massive balance sheet. It was at about $9 trillion a few years ago. It's now down to about $6.8 trillion. They buy these treasuries and mortgage securities in order to keep the yields lower and to prevent blowouts in the spreads of these assets. When they buy assets, they actually inject banking reserves into the financial system, reserves into the banking system. And when they let assets roll off or they sell them, they're pulling reserves out of the financial system. And that is what we call quantitative easing and quantitative tightening, which you may have heard of. The Fed has just ended its quantitative tightening cycle. But interestingly enough, and why it matters, is because we've actually still seen the loosest economic conditions going back to COVID. The third thing that the Fed really does, and this is kind of the third mandate that people don't talk much about, is that they run repo and reverse repo facilities. So what they actually end up doing is influencing short-term funding costs, and they decide what ample reserves in a banking system mean. That plumbing shows up in the things like the SOFR, which is that overnight repo rate that caused all that spasm in the last couple of weeks, and the effective funds rate. And when that repo rate is above the Fed funds rate, it creates tension in the plumbing of the financial system. It is the market telling you about collateral stress and balance sheet problems. Now, I know that this is very technical, and I know that it is a lot to hear all at once, but I'm pointing out that it's the plumbing that matters. It's not just vibes. It's not just feelings. This is math. This is data. So for traders, the key point here is the level of the Fed funds rate affects the discount rate of everything that you own. The size and the direction of that balance sheet that the Fed has impacts everything. It impacts risk appetite. It impacts funding in the markets. It impacts liquidity in the financial system. And it shows up whether we can have a nice, orderly risk-on rally or a sudden, stupid air pocket where nothing is changed except for the willingness of the big players to take action. Ultimately, what happens is we look at this and we listen to TV commentators say, did they cut the rate or not? The reality is that's the least interesting question of today. The question that really matters, and particularly in a world of Jerome Powell, economic conditions index, is whether or not economic conditions are expanding or not. And if we go back to COVID, and this is kind of the most important punchline to start the day, If we go back to the onset of COVID and we look at the National Economic Financial Conditions Index, this is done by the Chicago Fed, you could see when this spikes, that is conditions contracting in the financial markets, in the U.S. economy. And when COVID hit, it really hit. And then we had this period back in 2022 where conditions really tightened. If you flip this chart over, it looks exactly like the performance of the S&P 500 since January of 2020. Real quick, let's just look at it. The point that I'm making is that markets react to the financial conditions that are directly related to the actions of this central bank. So when we look at this chart and we look at the performance of the S&P 500 since COVID, you can see in this conditions index, there's the decline in 2022. Here's the sell-off in 2020, the sell-off in 2022, the most recent spasm that happened in the market back in April. The markets are front-running liquidity, 2020, 2022, 2025, economic conditions. Jerome Powell has been enabling, and so has the Treasury Department, loose economic conditions, even though the Fed has tightened its balance sheet. Now, they're not going to answer any questions about this. They're not going to talk about it. But that's kind of been what Powell's MO has been, to constantly look for playing a game of whack-a-mole to fix one thing in order to keep these financial conditions expanded. The question, unfortunately, is how is this market going to react to a rate cut, and will that rate cut improve financial conditions, or is that a signal of a weakening economy in an economy where only 10% of Americans drive about 45 to 50% of consumer spending at this point? These are big questions. And the real questions for today are, is this going to continue to loosen or tighten? And is the plumbing becoming more or less forgiving for the leveraged funds, the big players in the market that own all of these magnificent 7 stocks? And if financial conditions tighten, they have to unwind positions. And if conditions loosen, well, that means more leverage, more capital, more things flowing through the system. The Fed does not just set a rate, it sets the terms of engagement between leverage and liquidity in the system. And what do we define leverage as? The ability to buy one asset, go out, borrow more money using that asset as collateral, and doing it multiple times over and over again, which expands valuations, which leads to bull markets. As I've said, there's no such thing as a bull market. There are liquid markets and illiquid markets, not bull and bear markets post-2008. So as we look at this, yes, there's a lot going on. You have terms like repo and SOFR and RRP, and some people might be shaking their heads saying, Garrett, I don't get it. It takes a lot of time to get all of this. And part of me wishes that I could go back and not know any half of this stuff, because these are things that can and will drive you a little batty as you try to make sense of it. But if we zoom in on today and we treat today for what matters, and I mean it really matters, consensus across Wall Street is talking head parade is pretty clear, right? The Fed's going to cut by 25 basis points. That would be the third straight cut, and that would take us into a range of 3.5% to about 3.75 on the policy rate. Now, if everybody expects this, who cares? Because it's really not about will they cut, it's about how do they frame 2026. It is about how they frame the future. So the things that we have to look for are the dot plot. And the dot plot is this little blue thing where individuals who are members of the Fed Open Market Committee will provide their individual forecasts on where they think rates will be, not just in 2026, but also in 2027 and as far as 2028. And if the median shows one more cut next year, then done, that is known as a hawkish cut. It says we're easing a bit right now, but don't get comfortable. If they sneak in more cuts in 2026, there's a signal they're more worried about growth in the economy than they want to admit. And that in itself becomes bearish sentiment as well. You will hear a lot of terms about what's going on with the jobs market. One of the unfortunate situations right now is that we're still operating on data that we don't necessarily have. Now, yes, the Fed is flying blind and they can utilize the ADP reports, the private data roll reports, but they typically go by the government, the Department of Labor reports, which were not issued during that shutdown. The labor market has softened in some strange ways in the last couple of months. Job openings have cooled, hiring has slowed down, and wage growth has kind of peeled off a little bit. But we're not in an obvious recession territory. So today's cut may be sold as support for a cooling labor market, not a panic move. The media will be on this very quickly. If the statement, though, when Powell's Q&A leans hard into the labor market is weakening, the market will hear growth scare. And if he downplays it, the market will hear inflation scare. So what they say about the balance sheet in QT, this is the underwatched element of all of this. And again, softening metrics, narrative risk, growth scare versus inflation scare. The question is, everybody wants to know, is what is this process looking like for their stopping of quantitative tightening? That is a stealth pivot that matters more to risk than the actual activity that we saw with the 25 basis points. In the last couple of months, the Fed has signaled they're going to end their quantitative tightening process. Yeah, that matters. It matters a lot. But the Fed is also going to be buying about $20 billion of short-term treasury bills as something called maintenance. Now, they're not going to call this QE. One of the staples of Jerome Powell's tenure is engaging in quantitative easing-like processes, but never calling it QE. QE is kind of, on Main Street, kind of viewed as a bailout. It's not popular with a lot of people. It is a break the glass. But the point that I want to make is that when it comes to these concepts, these projects, these tools that Powell will use, like this new maintenance concept, or what they did with the banking industry in 2023 when they provided a bank lending program that allowed banks to use existing bonds that were trading at huge discounts to borrow money at par value, which was a bailout, but they didn't call it a bailout, and it was kind of QE, but they didn't call it QE. The goal of these programs is to have QE-like outcomes. And what does that mean? It means that the Fed's real mandate at the end of the day is stability. It's stability. So when we look at this is the last Fed meeting of the year. It means the dot plot, the statement, Powell's tone, all that narrative is set for Q1. And the market decides the Fed is basically done cutting. That is one playbook. If the market hears we're in an early cutting cycle, that's a different environment. If the market hears the Fed may be closer and closer to quantitative easing, that is a possible melt-up. The language matters dramatically. So when we set ourselves up for today, there is another element at play. Typically, the Federal Reserve is very united. They typically always vote in lockstep on whether or not they're going to cut rates or what other monetary decisions they make. But the reality is this: we have a different president. We have a president who wants and has said it out loud that rate cuts are litmus tests for the next Fed chair. So there is some politics to this. It's setting up to be a contentious meeting. Some economists expect there could be 2, even more 3 dissenting votes today that may be against today's cut. If that were the case, that would be the biggest dissent in 6-7 years. And dissent tells you something that markets ignore. There's no unified theory of the economy. There's no unification on what the expectations are, and that creates uncertainty. Some people see inflation risk as way too high for more easing, and inflation is elevated, and cutting rates can fuel inflation. Others think the labor market is soft enough that not cutting is a policy mistake. So that lack of unity shows up as volatility in the policy patch, and there's nothing more than business and markets hate more than uncertainty. You have to add on this idea that a split, you get more data dependency, more back and forth in speeches. That's an issue because the Fed will meet, and then in the next 2 weeks, all of these other players in the Fed will go out and give speeches. And that can lead to volatility. Bosnick in Atlanta is famous for this. He would come out and say something that completely contradicted what the Fed did recently. And all of a sudden, the market would go haywire. It would rise, it would fall. That's the type of thing that we're looking for, because if that difference of opinion shows up, it means that all of these meetings that are coming up are potential catalysts for rising and falling markets. Then you have to add that last layer. And you know what that last layer is, right? And it's President Trump. Trump has said that part out loud. Economic advisor Kevin Hassett is telling CEOs there's plenty of room to cut rates. He is openly criticizing the Fed for having acted politically in the past. And prediction markets have put Hassett as the favorite to be the next Fed chair, and Trump has called him the potential next Fed chair. So the setup for you as a trader is that Powell's term ends in early 2026. The current White House wants much lower rates and has said loyalty on rate cuts is the job requirement. Hassett is on the record pushing for immediate and larger cuts, saying that the Fed is not done. Also has argued that AI will help spur growth. What it means for today is that today's decision is not in a vacuum. Powell is not just reacting to CPI and payrolls, right? New chair, new regime, new person coming in doing something completely different than what Ben Bernanke, Janet Yellen, and Powell have done. So Powell is not going to be reacting just to inflation numbers and payrolls. He is defending the idea of the Fed as a policy independent policymaker, and knowing that he might be replaced by someone who wants to take a chainsaw to rates. Pretty important. So when you listen to the press conference, pay attention to his body language, listen to the legalistic language. If he hits independence repeatedly and he leads into data dependence and he over-explains the rationale for the current path, that's not just economics. That's him trying to write his legacy in real time. And yes, they all do it. Greenspan did it. Bernanke did it constantly. And even Yellen. Yellen said that she wasn't a political animal. She was the most political animal for 30 years. She just played a sweet little grandmother on television. For markets, here's what the policy layer means. A near-term path of rates is about data. The medium-term plan is about who runs the next Fed. So if you're running past 2026, if you have a model, a scenario where Powell is gone, Hassett or someone similar is in, and the Fed is more willing to cut rates and tolerate higher inflation in exchange for growth and stock prices. And that is the private equity playbook. Letting inflation eat away at the debt and letting growth and equities do the heavy lifting. Now, the reason that a lot of this stuff is so important is because the big question is about a policy here. Okay? Before you do a trader checklist, I want to walk through some of the Fed's greatest hits on policy here because they got a lot of them. Not to dunk on them, but to calibrate risk. Too late to hike, too fast when they first started. They called inflation transitory in 2021. You remember this one. They held rates at zero while QE was running, and then when they realized that the fire was real, they slammed the brakes on and engaged in the fastest period of hikes in modern history. The result was the collapse of a variety of economies and monetary bases around the world, and ultimately the gilt crisis that happened in Europe because the Bank of England tried to keep up with the Fed And again, that crushed speculative mania. It led to Bitcoin falling to 15,000. And then there was the next great one. That was 2018. That was over-tightening too. They hiked into a slowing global economy. The markets cracked in Q4 of that year. Credit spreads widened, and they had to pivot. And it was a masterclass in that financial conditions matter more than their theoretical model. In 2020 and 2021, they engaged in bazooka QE. They literally just dumped money out of a helicopter when COVID hit. Today's risk is different. The market is braced for a lot of strategists are calling this hawkish cut. We cut by 25 basis points, but we wrap it in this language that we say, don't expect too many more cuts. Inflation risk remains there, and we might pause for a while. The policy error in that time would be pretty simple. It is the idea of not a no cut versus the word cut. The policy error would be cut, but sounds so hawkish that you end up tightening financial conditions anyway. Or sounds so dovish under heavy political pressure that the market decides the Fed has given up on inflation and starts repricing premiums and the dollar. And the 30-year goes up, and the 10-year goes up, and the bond vigilantes show back up again. The people who say, why am I going to lend money to the United States government if I can't get a real return and stay above inflation? So in either case, you're going to get this situation where a 25 basis point move could be a nothing burger at first, ends up triggering big rotations out or into duration, out or into cyclicals, out or into dollar trades. When you hear 25 basis points, translate that into, is this cut loosening or tightening financial conditions once you factor in that language? And we will be walking you through all of that later today. Now, the checklist for today is pretty simplistic, right? The things we're watching, the 2-year yields, the U.S. dollar, the first paragraph of the Fed statement, the QT language, the dot plot. But the real question is, what do I do at 155? And you got to ask, like, what's the market doing right now? Look at the Fed funds rate, the 2-year yield, the CME Fed Watch equivalents. Know the base cut is 25 basis points. The question is, how many future cuts are priced? CME Fed Watch has some pretty aggressive moves here for later next year into June. The expectation of not just this cut, but another cut, the possibility of another cut, and you go all the way out to 2026, you see people making bets on the fact that we might go to 2%. That is an aggressive Hassett is going to be in charge type of bet. But if the market comes out today and says no, Fed says no, we're not cutting in January. We might not even cut in March. Because remember, Powell's still going to be at the helm. Well, all of this needs to be unwound. The question is, how many future rate cuts are priced in? Today is already people expecting it. So at 2 p.m., we want to watch 3 things right away. Obviously, price. Volume weighted average price. What's going to happen with VWAP on the S&P 500? That's going to be our trade. That's going to be my focus. I've walked you through this quite a bit. We go to TradingView. We watch the SPX. And again, I said this about last Thursday. The SPX bounced into its 4th standard deviation band and came right back. What am I looking for? Here is volume weighted average price, this blue line. These are your deviation bands. If we get down into the 4th deviation, if we get down deep into the 3rd deviation, I'm going to look for this market to squeeze back up. If we are up here, I am sitting with my hands under my legs. I'm not doing anything. I am waiting and looking at 155 for a move down here. If it comes, it comes, and I look for a rebound and covering in that period of time. In addition to that, when I'm watching, the 2-year yield, if that yield spikes, the market is hearing a hawkish cut. If it breaks lower, the market hears we're at the start of a deeper easing cycle. At least that's the initial thesis. We'll watch the dollar yen. This has been one of the purest expressions of rate differentials. The Japanese central bank is expected to raise rates next week. And that impacts the global carry trade. That impacts their 250% debt to GDP. This is a very significant element. And then we'll be watching in the hours later to what happens with the SOFR and the effective funds rate, because we're looking to see if no rate cut causes some level of stress. In the first paragraph, any softening on language on quantitative tightening, on reserves, on the money markets, that is a stealth liquidity pivot. That matters more than the headline cut. During Powell's Q&A, we are listening for 3 words. 3 words. Data, independence, and political. Count how many times he defends the institution. That is your barometer of how much he feels the need to push back against Trump and the Hassett narrative. And ask yourself one final question at 2:05. Are the financial conditions easing or tightening on net after all of this? If yields are up, the dollar is up. Credit spreads are wider. If the equities fade after the initial pop, that may signal tighter conditions. If the yields are lower, the dollar is weaker, the credit is stable, and growth names catch a bid, those are easier conditions. But also be aware, possibility of what tends to happen in this 30-minute period. At 2 o'clock, the announcement comes. At 2:30, Powell speaks. What I tend to look for on a day like this, because it happens so many damn times under Powell's period, is that the markets squeeze higher between 2:30 and 3 o'clock. And then at 3 o'clock, that's where the institutions start to let go of their positions. That has been the baseline for the last dozen Powell meetings, a move up and a rollover in that final hour, which is why I will be leading these sessions today, focusing on that last 3 hours. I'm going to go from 1 o'clock with our NVIDIA crew, and then from 2 o'clock, I will be here with Don. And we're going to continue just to have a deeper conversation about what this means, because this is, I hate to say it, I hate when people say, well, this is the most important Fed meeting in 5 years. Okay, but it is. It's the end of the year. It's the end of Powell's term. It is the inflection point. We are heading into Third Friday next week. And historically, Blake pointed this out, if the market is down in the fourth quarter, and we start to see selling soon, well, that creates a situation where we start to see a lot of tax harvesting, which means we see selling into Third Friday, potentially even a little bit longer. We could see stress in the money markets like we saw last year. And ultimately, what we then look for is that rotation at the end of the year. This is the starting point of a very critical 3-week period for the equity markets. There is a lot of noise out there. There are a lot of questions right now. And that's why we do what we do. We get up at 8:45 in the morning and we go until 4 o'clock each day. So if you're not a member of TheoTrade, today is literally the single best day to get into our member room, name your price. You got 1 month, make a decision, name whatever the price is today. Follow through into Third Friday. Listen for the rotation news, particularly at the end of this month. And then watch those first few days of 2026. Because what happens today is going to set the tone for not just the next 3 weeks, but where capital will flow in the first week of next year. And my thesis remains that if Hassett does become the Fed chair, it signals a massive paradigm shift in the thinking of what the central bank does. There's going to be a lot of dissent within the Fed, particularly the 200 PhDs who don't think like him. And at the end of the day, the question will be, are we actually going to see a market that rewards fundamentals, that rewards strength and quality and potentially value? Or is this going to set the tone for more of the same that we have done for the last 17 years? The market's been waiting for this. And we're either going to see one of the greatest rotations into quality and value ever, or we're going to see the continuity of a market that has been fundamentally driven by liquidity and leverage. And it all starts today at 2 o'clock. All right. I will be back at 2 o'clock with Don. I want to thank you guys for listening to the monologue today. It was a long one, but I hope you got a lot out of it. And I hope that it does teach you that this is not just about headlines. This is not just about people getting on CNBC and dropping balloons from the ceiling if they cut rates. It drives everything. It is a really, 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 really important thing to understand. And it's not educated at the right level simply because, well, not a lot of people take the time to look behind the curtain. I thank you guys very much for today. I hope you have a great trading day. I will be back later, 1 o'clock with my NVIDIA crew, and then from 2 o'clock to 4 o'clock to wrap up this trading day. Have a great day.